Pyramiding. If you buy a stock at 50 and it falls to 40, you should buy more shares and decrease your average cost, right? Wrong. Okay, let me ask you another question. If you buy a stock at 50 and it rises to 60, you should not buy more shares and increase your average cost, right? Wrong again. Sometimes after you enter a position or buy a stock, it starts going up. Now it may not go down immediately as the rest of the world catches on, and so you may never get another chance to buy more at a lower price. What do? You pyramid. Pyramiding is the best way to average upwards. This is my version of pyramiding. There are others, but for the purpose of this video, I'll explain it as a simple concept. Pyramiding is non-conventional. Pyramiding is when you buy less and less on the way up, not more and more on the way down like people do with dollar cost averaging. You'll have a relatively lower average price that can protect you from losses. If the stock goes down from there, you're lucky. Let's take an example. Let's assume a 7-day trading period, and each day the price rises from 100 to 110 to 120 to ultimately 150 on day 6. And during that time, you pyramid by buying less and less number of shares. So on day 1, you would buy 50 at $100. On day 2, you would buy 45 at 110, and so on until you reach day 6, where you would buy 5 at $150. And when you do this, the actual value that you're buying is reducing as the time goes by. So by the time you reach day 6, you've actually bought much less than you would have. Now the total value is increasing, but you're buying less and less. So on day 6, we now have 18,300 on a rising stock. The total number of shares, of course, is more at 160. But the average price per share is 114, much lower than you would expect. Now, if the price went down by 25% from 150 to 113, using our trailing stop strategy, we would exit. Then the potential loss could have been 16% at a normal average price of 125. But by pyramiding, it would be almost zero. The maths is very simple. Let's note that the average price per share, if we bought 50 shares each time the price went up, would be about 125. I mean, just do the maths. 100 plus 110 plus 120 plus 130 plus 140 plus 150 is 750. Divided by the number of days is 6 days. Now this is assuming that you're buying the same amount of shares every day. Again, this is just an illustration to help explain the concept. How much you actually add on each day depends on how much you're comfortable allocating to a particular position. You would have to use this strategy along with the trailing stop strategy. Now, pyramiding is based on the logic that you would build your position or pyramid on a good foundation. That is, when a stock is moving higher. And generally with momentum, stocks build higher and they go higher, and it generally continues in that direction for some time. It's almost like the law of inertia, if you remember what they taught you in physics. Now, you might be thinking that with each trade, you're increasing your trading commissions. Yes and no. You see, if you're using brokers like TD Ameritrade, then yes. If you're using interactive brokers, which charge only $1 per trade, then it's a definite no. It's actually irrelevant. As you build your pyramid, you're easing into a winning position while reducing your risk. Now imagine a situation where a stock continued to rise and you had a gain. Every day, day 1 to day 5 to day 6, the position ownership that you had would be added on in small amounts. During this time, you'd be reducing your risk level and the chances of you losing more money. And this has happened to me, and you wonder, I wish I had a bigger position in that. Why didn't I buy more? I wish I had invested more. Well, it's happened, and I can tell you one thing for sure. Pyramiding can help you stop wondering and start acting. When a suit is on sale, you'd probably jump at the opportunity to buy at a lower price, but suits are not stocks. Any asset that is falling in price probably has a reason behind its fall. It's a sign that something's definitely wrong. Now, we like traders do not average down, that is, buy more stock when a price is falling. be it falling or a rising market. The only time I recommend averaging down is when you are rebalancing and it's a part of your asset allocation model, or if you're following a dividend builder model. Don't try catching a falling knife, and don't throw good money after bad. Cut your losses quickly and ride your winners. You may not know what the problem is that is causing the stock to fall. It could be that the sales are down. Perhaps the company has lost a major customer, or expenses could be rising unexpectedly, or a new competitor has emerged and is taking market share and driving profit margins down. Whatever the reason, just remember to never catch a falling knife. So what did you learn today? Send me an email as to what the most important lesson you learned from this presentation. I'd love to hear from you.